You concentrate to build wealth and you diversify to preserve it. That was the saying we used when I was at Goldman Sachs. Not in the marketing brochures, not in the client presentations, in the back rooms where the real money worked. And it's the complete opposite of what Wall Street and your financial advisor are telling you to do. I'm about to tell you something that will get me kicked out of every single financial advisor conference in the United States. If you are under 40 and you are trying to build wealth, diversification is your enemy. I know. That literally contradicts everything you've ever been taught from your parents, from your 401k advisor, your finance book that you picked up when you learned about how to invest. But here's what I learned from working with people who had $100+ million at Goldman Sachs and when I was at Fisher Investments as well. None of them, not one, got there by spreading their bets out over time. They got there by making one big bet, winning, then diversifying to protect their holdings. Today, I'm going to show you the data, the math, and my own numbers that prove concentration can get you to financial freedom up to 15 years faster. I'm Arie van Gemeren. I worked at Goldman Sachs. I was an equity research analyst with Fisher Investments, and I now run a $150 million plus real estate investment company called Lombard Equities Group based on the West Coast. And I'm going to show you how wealth is actually built. Picture this. It's 2014. I'm sitting in a conference room at the Goldman Sachs Private Wealth Management Group in San Francisco. Across from me, an entrepreneur who just sold his software company for $180 million in cash. He's asking me the question every new wealthy person asks. What do I do now? How do I not lose this? And here's what I learned over years from these meetings. Not one of our clients made their money through diversification. The software guy, he built one company for 15 years. He concentrated on building something that he could control and would produce a big outcome for him and his family, and it worked. The real estate developer, one market, one asset class, concentrated as all heck. The hedge fund manager, some of them, the big shorts, for example, they didn't make their money from a diversified portfolio that, was whatever. They made it by shorting the housing market, right? And there's a number of them. There's a number of people in the San Francisco Bay Area, not of the Michael Burry level fame, but hedge fund managers in the Bay Area who made a ton of money off of one big asymmetric bet that worked for them. And then, and only then, did they diversify. That was the pattern over and over, dozens of families, hundreds of millions of dollars. And it's a pattern, by the way, that is observable throughout history as well. Many of the great creators, Andrew Carnegie, worked his entire life on building one company. John D. Rockefeller, his entire life on one company, and they made it big. The Waltons, their entire life on one company, building something great. But somehow, this script got flipped over time. Now, the industry tells 25-year-olds making $60,000 a year to diversify across 12 asset classes and rebalance quarterly. And look, I'm going to say, it's not bad advice, okay? If you're making $60K and you're putting 10% into a diversified 401k, that is infinitely better than doing nothing. It's smart, it's responsible, and hopefully you will be able to retire comfortably. But here's what Wall Street is not telling you, because that model is also built on them collecting fees. They want you to work with them. They want you to invest your money over time, continue to pour the money into managed portfolios, managed 401k accounts that they can collect fees on, okay? There's a reason your Wall Street advisor doesn't like real estate. They can't control it. They can't fee on it. You own it. You control it. There's a good reason that many people just do this because it is the right path for many people. But if you have greater aspirations, there are better ways. There are better ways. This advice is for Wall Street's fee-taking benefit and for your own financial security in the long run, because concentration can go wrong, and we will go into that. But it doesn't give you financial freedom earlier. If you want to just not be broke in retirement, then diversify from day one. You will be fine. But if you want to be free of the system before 65, if you want generational wealth, if you have grand aspirations for what you want to accomplish, if you want to completely change your family's trajectory, you have to do something different, okay? And that something is concentration. Okay, let's get into the numbers because this isn't just opinion, this is math. According to wealth research, roughly 67% of billionaires globally are self made, not inherited. And how do they do it? I'm gonna give you some big notable examples, right? Elon Musk, Tesla, and SpaceX. Tap to double click briefly on Elon Musk. Fascinating. When he sold PayPal, he took all the money he made from PayPal and he literally lit it on fire by building rockets and launching them into space. And each rocket was like 15 million bucks. Poof, poof. But he did it, right? And I often have this question with people. If you just sold PayPal and you made $180 million, would you go all in on blowing your money up to build rockets to go into space? Probably not. And most of us aren't going to do it. And most of us would be incredibly happy with $180 million. By the way, 180 million, great, fantastic generational wealth outcome for you and your family. Elon did it with concentration, investing in one thing. Mark Zuckerberg, Meta, Facebook, right? One business, one concentrated bet. And it's not just the billionaires, okay? It's easy to glamorize John D and be like, wow, he did it. That's amazing. Realistically, that outcome is not realistic for most of us, and it's never going to happen. But there are good outcomes that are out there that are really, really good. The aforementioned $180 million is a good outcome. And when I was at Goldman Sachs, I worked with dozens of families that were worth $50 to $100 million. And I'll tell you this, not a single one of them made their money in a W-2 job with an index fund strategy. Not one. Here's a stat that will blow your mind. This comes from Professor Hendrik Bessembinder at Arizona State. Massive study, decades of data. Only 4% of stocks in the US stock market created 100% of the net wealth in public markets. Globally, just 2.4% of stocks generated all net market gains from 1990 to 2020. The other 97.6% basically matched treasury bills. They did almost nothing. So when you are told to diversify across 500 stocks, you're basically guaranteeing you will own 490 companies that do nothing. Now, the caveat, how do you pick the 4%? That is the natural pushback on this point, and it is a fair point, which is why indexing is not a bad strategy, okay? But I want to talk about active management for a moment. So this one's from academic research by Kremers and Petahisto. Fund managers who concentrate, okay? So now you think about this in terms of an allocated portfolio for yourself. If you're thinking about where to hedge your own bets, right? If you decide, okay, Arie, I like what you're saying. How do I apply this without blowing my family up somehow? Active managers who concentrate, i.e., they take concentrated positions. They own 8 stocks, right? Like Philip Fisher, for example, fantastic book, Common Stocks and Uncommon Profit. Philip Fisher was a huge advocate of owning max 8 stocks and deeply understanding your stocks. But there's research supporting it. Those managers outperform closet indexing managers, right? What is a closet indexer? A closet indexer is a stock manager that manages your portfolio, but their portfolio pretty closely tracks like the S&P 500. So like, what are you actually getting, right? Concentrated managers outperform 1.5% to 2% annually versus closet indexing managers. Another study showed that fund managers' top 3 to 5 holdings drive most of their alpha. And I can tell you from the time that I spent as a venture capitalist, your top 1 or 2 companies drive your entire fund's return, right? It's like a power law distribution. The most important thing are the bets that actually win. So the translation, the best ideas win. Everything else is just noise. Now, here's what I want you to understand. This isn't just about the stock market. And I have to point out, I am not advocating that you go out and buy one stock with all of your retirement funds and do that. It's a bad idea. Please don't do that. That's not what I'm saying. Building a company is concentration, or owning real estate, which I'll get into, is a form of concentration. When a 28-year-old quits their job, cashes out their 401k, and goes all in on a business idea, that is a concentration bet. That is an investment decision on the part of the entrepreneur that's building their company. They're concentrating their time, okay, their prime earning years. They're concentrating their capital, their life savings. They're concentrating their energy, and they're concentrating their opportunity cost. There is no W-2 safety net. And again, I'm not telling you to buy one stock and pray. That to me is gambling with zero control. I'm telling you that real wealth, The kind that changes your life comes from concentrating on one thing you actually control: a business, real estate, a skill you can monetize. Focus wins, dilution loses. All right, so let's get personal and let's just talk through a couple examples of this in practice. So meet Dave. He's 25. He reads books. He does everything right. He invests $100,000 per year. His diversified portfolio returns 9% annual returns, and he does this until age 45. After 20 years, he has $5.12 million on $2 million total invested capital. It's not bad. Dave did great. He will retire comfortably in his 50s or his 60s whenever he chooses to hang the old cape up and go off and play golf, right? And honestly, for most people, this is a fantastic outcome. Dave will probably never worry about money. He'll have a comfortable retirement. His kids will be fine. This is way better than the majority of Americans who save nothing. But let's look closer at what this took. To invest $100K per year after taxes, Dave needs to earn at least $153,000 a year, assuming a 35% tax rate, plus living expenses on top of that. And he can't touch this money for 20 years, not during the '08 crash, not during COVID. He cannot panic sell. He must have iron discipline, which, if you follow our series on behavioral finance, we talk about this extensively. Like, beating yourself is the hardest part of the game, okay? Most people can't do this, but let's just say Dave can, okay? He did it. He's 45, he has 5 million bucks. He's comfortable, he's secure, but he's not free, not yet. He still works. He is still grinding. There's nothing wrong with this path, but it is not the path to generational wealth. It is not the path to being free in your 30s or 40s. It is the path to a comfortable retirement. It is the path that Wall Street wants you to take because they can clip fees unless you index with Vanguard. Great strategy as well. Now meet Sarah, the concentrated investor. Sarah is also 25, same income, but she does something different. She invests $100,000 per year for just 6 years, but she concentrates her investment in real estate or a business. And there's going to be a big if here, or caveat here. It works, okay? We'll get into that, but it works and it returns 30% per year, which is a totally reasonable outcome if you run your own business and it's a successful business. Or it's a reasonable outcome in real estate on a levered basis if you're a good real estate picker and you do a good job. And she stops and she lets it grow at normal rates. So in 20 years, she has $6.4 million, but she only invested $600,000 in a more concentrated bet. Same outcome, but Sarah invested $1.4 million less and she built wealth 14 years faster, okay? That's 14 years of freedom Dave did not have. This is why concentration matters, not because it's riskier, not because it's sexier, although it is both of those, but because it's time is the asset nobody talks to you about. This is not theory. Let me tell you about my first real estate deal I ever did, and then let me tell you about the founding of my company. So in 2012, my wife and I made a bet and we bought our own house. Okay. And we didn't just buy a house. We made a concentration bet. We bet everything. We bought this little place in the San Francisco Bay Area for $500,000, which for the listeners that are elsewhere in the country, you'll think that's an astronomical price for a starter home. I agree. It was astronomical. And we had no money in our bank account. Like, it was nothing. Like, we did everything that the book says don't do, right? Went all in on it. And the reason is I was a stock guy. I was an equity research analyst at the time. I was all about diversifying, indexing, tracking the MSCI World Index and building a portfolio over time. But my wife's family was big into real estate. They understood real estate and they said, you got to do real estate, or you got to get into it. So we bought this old place. Okay. It was a 2-bed, 1.5-bath bungalow. And for a year, we lived in that house while we did what we call a live and flip. Okay. It had a massive master bedroom. We chopped it in half. We made it into 2 bedrooms. It had a carport. We turned it into an actual garage. It had a half bath, right? Half bath. We turned it into a full bath. So we converted our 2-bed, 1.5 bungalow, 1.5-bath bungalow into a 3-bed, 2-bath home with a garage. And so what did that do? So purchase price, okay, we invested $60,000 into it. $60,000, by the way, that we didn't have. So every single month we're scraping, like getting by, just barely getting the money into it, living in sawdust and billowing sheets. Like no money was going into the stock market. None. Like we were just fully in on this strategy. But it appraised after we did that for $1 million. So we only put in about 150 grand, right? It was levered. So I took 150 grand and I made $500,000 roughly. The math is not perfect here, but like these are the actual numbers, the appraised value, all this kind of stuff. So I like quadrupled my money in a year and a half to 2 years. I'm not saying that's easy to do, okay? But we did it. We were willing to live with discomfort, billowing sheets, not having a home that was acceptable for people to come. We didn't have children. That was helpful, okay? I'll get into a child with children risk concentration bet as well for you shortly. That's what we did. That's a roughly 22% return on our initial capital. But here's where the story gets even more interesting because I took the earnings, right? And this was during the low rate period. So there's like caveats to all this story. But during that low rate period, I did cash out refinances. I pulled $300,000 out, maybe more, maybe 350. And I used that to buy 2 apartment buildings, okay? And did the same strategy on them. So those buildings, I got another $300,000 in equity gains on those, right? Raising rents, doing the stuff that real estate investors do, having control of our investments. It was a concentrated bet in real estate. May blow up on me at some point, but it worked, okay? Now we're talking about a 29.7% annualized return in 9 years. This is not genius, guys. This is not me being special. This is concentration plus leverage plus an aptitude for risk, which I have, and this focusing limited resources on what you understand and using the equity to keep building. And yes, guys, this did cost me something. I've lost sleep. I have had anxiety that never existed when I had a salary. I've questioned where the next deal was coming from. There's all sorts of mental cost to going this route, which I don't want to diminish, like they're real. But I'll tell you what I did learn. My regret quotient for betting on myself is very low. I don't feel like I left anything on the table. Let me tell you one other quick anecdote. The last year I was employed in venture capital, I went to my boss and I asked for a pay raise. I said, I've been earning this amount of money for a long time. Will you consider giving me a large raise? 6 months later, they said, no, we're not going to do it. COVID hit. I got let go. I lost my job. And I had a choice. I could go back and work for a private banking institution, of which I had several offers to do, or I could go my own way and start my new company, Lombard Equities Group, my real estate investment company. I chose the entrepreneurship route because I'd already had this training in concentration, real estate investing. I'd already done everything I just described to you before this point. In the next 2 years, I made more money in my own business, running my own real estate investment company, than I ever made working for Goldman Sachs. That concentrated bet has the potential to create generational wealth for me and my family. The potential. It could go wrong, okay? But my regret quotient is pretty low. I don't think I will ever regret making the decision to go for it and do a concentration strategy. This is exactly what Buffett and Munger did and what they said to do, right? Warren Buffett, this is a direct quote, diversification is protection against ignorance. Charlie Munger said, if you know what you're doing, 4 or 5 investments are enough. They have built fortunes of hundreds of billions of dollars through concentration. Now they diversify. Arguably, they don't even diversify now, although Berkshire Hathaway is a relatively diversified holding co. All right, enough with the glory stories. Let me tell you the dark side because this is important. Concentration can destroy you. And this is why I need to be clear. Concentration is not for everyone. If you're not psychologically equipped for risk, if you can't handle sleepless nights, if you need stability, please diversify. Put money in your 401k, sleep well at night. There is zero shame in this path. It is smart, it's responsible. You will still be better off than 90+% of Americans today. But if you choose concentration, you need to understand the risks. I know 2 people right now, real estate investors, both in their late 60s, both bet heavily on massive real estate projects in the last 5 years. Both of them are facing bankruptcy. One is actually in bankruptcy. They're not stupid. They're experienced. They have decades in the business, but they made 2 significant mistakes. They concentrated at the wrong age. At 65, you really cannot recover from catastrophic loss. It's a fact. 2, they never pivoted to preservation. They kept playing the wealth building game after they'd already won. So this is why age does matter in this evaluation. If you're 25 to 35 years old, you can bear 70 to 90% concentration risk. Okay. You have the time. Something goes wrong, you will survive. your maximum risk, maximum reward. I'm 38, okay? 39, actually. Sorry. I'm 39 and I'm still in the wealth building game. I'm still concentrating. I still have time to recover. I could probably get a great job somewhere if I needed to get one. I can rally back from a bad outcome. My regret quotient is low. 35 to 50, 50-50. Start shifting, start transitioning. If you feel like you've gotten there, how much is there is a good question for every individual person. But I'd argue there's a number that's like, that's enough. Okay. Start to transition. 50 plus, I would say probably start diversifying heavily. Like you're preserving at this point. Maybe you're still building, right? But never say never say too late. The Colonel of Kentucky Fried Chicken, I believe, started his business at 66, 67, or early 70s. Someone give me the actual number in the comments, but he started late, right? So it's never too late to concentrate and go in, but you have less time to recover. Okay. You just have less time. So be mindful. This is the golden rule. Concentrate to build, diversify to preserve. Most people do this backwards. They diversify when they should concentrate, and then they try to concentrate when they really should be diversifying. Again, up to you how you want to think about this and what direction you want to take. But comfortable retirement through diversification is still a win at the end of the day. So why am I talking about real estate when there are so many forms of concentration? I'm biased. I'm a real estate guy. It's my business. It's my lifeblood. It's what I do. It's what I pitch. I'm biased. Let's just get that out of the way. Look, building a business is the highest potential return. The people who started a tech company and sold it, their upside is unlimited, but it's also the hardest and it's the riskiest. Okay. Not everyone has an idea worth building into a company. Many companies fail, most fail, right? So it is very high reward, very high risk. Now, buy a single stock, that's concentration with zero control. You're a passenger. That's the form of concentration I am least in favor of. It is the most risky to take. But real estate is, in my opinion, the sweet spot because real estate gives you what stocks can't and what businesses do give you, which is control. In real estate, you can control the improvements that increase value, the rent increases that can boost your cash flow, the financing that amplifies your return, and the tremendous tax benefits to the asset class that can preserve and build wealth for you over time. You cannot call Apple and tell them to improve their margins, but you can improve your property's net operating income, the income it earns after all income and expenses are accounted for. Plus, real estate gives you 4 return streams, return levers that are very important. You get cash flow from rent, you get appreciation over time. Okay. There are years when it depreciates. You can get appreciation over time from market forces. You get equity buildup from your mortgage paydown, and you get tax advantages from depreciation. And here's the kicker. Frequent shows first-time real estate funds average 18% net IRR. These are operators still learning, and they're beating the stock market average. In real estate, you are the edge. It's concentration with control. It's like business style returns. It's never going to be a Facebook outcome. Okay. It's not going to happen unless you build a real estate investment company, which is what I'm working on. But it is like a business in the sense that you have control. It is a business, right? You provide a service business to the residents or to the tenants or to the restaurant that occupies the space. You are providing a service and a business and a space for people to operate. It has higher return potential than just investing in the stock market. It is betting on yourself with real assets backing you up. So here's the truth that nobody in Wall Street wants to tell you. There are 2 different games. Game 1 is financial security. Diversify from day one, steady contributions for decades, comfortable retirement, and this is a good game. Most people should play in this field. Game 2 is concentrate when you are young in riskier, higher return assets that could potentially be a game changer for you. Build through focused execution of your mental skill sets, execution of your mind, whatever it is, build. Seek generational wealth. This is a different game. Higher risk, higher reward. Neither is wrong. They're just different paths with different outcomes. If you want game 1, no shame in the game. Go diversify, max out your 401k, follow the conventional wisdom. You will be better off. But if you want game 2, if you want to be free before 65, go live in Malta, go live in, the Carib, wherever, and have a nice little plot and not do anything. game two is the one. The biggest risk is not concentration. The biggest risk is trying to play game two with a game one strategy. 20 years from now, you'll know which game you played. The question is, which game do you want to play? If you found this valuable, subscribe. I break down wealth, real estate, timeless principles every week, lessons from history, how we can apply the timeless principles of wealth builders, crashes, market implosions, everything to make ourselves owned, better investors today, in the present, in this wonderful world we live in. And if you're serious about game two, grab my book, Timeless Wealth, link in the description. The strategies that worked for the Medicis, the Rockefellers, Sam Zell, they still work today. You just need to know where to look and which game you're playing. Think well, act wisely, build something timeless.